In this session, I'm going to present the ultimate guide of how to start trading in a small account. For those of you guys returning to the channel, you know we're about to jump into a deep dive. And for those of you guys who are brand new, let me briefly introduce myself to you. My name is Ross Cameron. I'm a full-time trader. I funded my first account in 2001, and in 2013, I created this YouTube channel right here to begin sharing the strategies and the techniques that I've found have worked so well for me over the years. I am probably best known for turning a small account with less than $600 into what is now more than $20 million of gross profit. So everything I share with you today is not just theory of what I think may work in the market. It's actually tried and true strategies and techniques that I use and implement every single day. So we're gonna go ahead and jump on the screen share. We have a lot to cover. You can see my profits from today sitting up $21,690.15. And I should be the first to tell you that my results are not typical. I have been trading for a long time. There's no guarantee that you'll find success in the market. And this actually reminds me of a topic that came up at a birthday party I was recently at. Before I share that with you, why don't you look at these 9 topics that we'll be covering in today's deep dive. So I'm gonna walk you through how to start trading, and I'm gonna do it sequentially, going through these 9 topics, which I would consider to be essentially the building blocks of learning how to trade. So these are the building blocks. This is how we're gonna set our foundation right down here. And as I touch on each of these concepts, I don't know if that's 9, but you get the idea. What you're gonna recognize is that I'm gonna do initially cliff notes. I'm gonna give you high level for each of these topics, each of these concepts, and then what we do is we go back to them and we add more detail, more detail, more detail, until eventually you have a solid foundation. And my goal is to help you prepare for day 1 of trading in that small account. Now, by the end of this session, you're gonna actually have a PDF worksheet that you can take away with you and a strategy, an outline of a strategy and a trading plan that you can begin implementing in your own trading starting today. Now, if you wanna download that PDF, I'll put the link in the top of the comments and also put in the description so you can download the PDF resources, you can print them out, and you can follow along with them as we go through this class. Now, before I jump into part 1, which is alpha phase of sim trading, let me tell you about this little story. So I was at a birthday party recently, and someone came up to me and they were asking me what I do for a living. And I said that I'm a trader. And I also said that I'm a teacher and I provide a lot of content on YouTube and so on and so forth. But they were really curious about trading. And I explained to them that, of course, that I am a trader. And they said, well, so what do you do? Do you trade, the S&P 500? Do you trade oil and gold? They had no idea the area of the market that I traded. They asked me this question. They said, how do you know what to trade? And I said, I'm going to explain it. And when I explain it, it's going to click. And so what I said is that I am a volatility trader, which means I make money trading things that are moving. If something's not moving, I can't make any money on it. And so what is typically the catalyst that gives it a move? And I asked the question and they said, a catalyst that gives you a move. I guess some type of breaking news. I said, exactly right. And so they said, oh, so you must sit reading the Wall Street Journal and reading the news like all day long? Is that what you do? Do you listen to Bloomberg and this and that? And I said, no, I don't do that. Because there are hundreds and hundreds of news stories coming out probably every hour of the day. You'd be inundated with news. You would never know where to begin. So no, I don't read all the headlines. I work the other way around. I look for stocks that are already starting to move. And if a stock is up 10%, just by being up 10%, it's doing something that 99% of the stocks on the market are not doing on any given day. Most days, stocks go up and down a little bit. Going up 10% is statistically significant. So once a stock has broken that first threshold, now I just have to go and check to see whether or not there's a catalyst. And 9 times out of 10, there is a catalyst. So rather than reading all the news headlines and trying to comb through what's good, what's bad, I just wait for the stocks to show themselves to me. So does it mean that I missed the first 10% of the move? It sure does. And I'm okay with that. Because typically, when we have a stock with a really good catalyst, a company that comes out with FDA approval for a new drug that's going to treat a very common illness, that type of catalyst can send a stock up 500% in a single day. So even if I miss the first 10%, it doesn't matter. I'm still going to be getting in very early. So she said, well, this all makes sense. In fact, it sounds downright simple. You just look for stocks that are moving, you check the catalyst, and then you get in. And I said, exactly. She said, but I've heard from people that trading is very difficult and people lose money. Why do they lose if it's so simple? And I said, that's right. It is simple. And yet people continue to struggle. Why is that? It's because they can't get out of their own way. And this is the most important thing that I want you to learn right here, right at the very beginning. Success in trading is about following a playbook, following a set of rules. It's about a system. And what traders who lose often do is they think they know better and they break the rules of the strategy. Why would you do that? It's because your intuition of what you think you know feels right. I'll give you an example. If you've ever gone fishing as a kid or even as an adult, whatever, if you've ever got a fish hook in your thumb or in your hand, your instinct, what's your instinct to do? Your instinct is to pull it out. Now, if you pull it, the barb is going to hook even deeper. In fact, what you need to do is you need to push it in to release the barb. You got to push it in. Now, pushing it in feels like the exact opposite of what you should do. I'll give you another analogy. Think about being in quicksand. What do people do? They flail, and they sink deeper. What do you have to do? You've got to stop. You've got to spread yourself out. So sometimes, as is the case in other aspects of life, your intuition doesn't serve you well. Your gut response, your gut reaction. And that's exactly the case in the market. Your gut reaction of when to buy and when to sell, by default, will lose you money. That's the reality. So we actually have to follow a very specific outline, a system, a set of rules in order to achieve predictable results. And so what I'm going to share with you is exactly that blueprint. I'm going to make it as simple as I can, but it requires you to have the discipline to follow the rules. And that's what can be very challenging. All right, so we're going to go ahead and dive right in here. We've got a lot to cover. I'm going to begin right here with Alpha Phase 1. And as I already mentioned, everything that I share with you here is actually based on my own success. It's based on my own trading profits. This is not just a theory of what I think might work well in the market. This is all based on what I actually know to work well in the market. It's data from over $22 million of trading profit. And this is as of today. I just exported this just this morning so I could have this updated. Now, I also want to share with you that I am no stranger to these small account challenges, as you already know, and I'm actually getting ready to begin a brand new challenge. And every time I do these small account challenges, I also couple them with a fundraiser. And so for this challenge, every dollar that I make will get donated to charity. However, I will give you guys the opportunity to help me double that donation. So in addition to me donating all of the trading profit that I make, I'm also going to offer a double. So I'll go ahead and double whatever I make in trading. And the way you guys can unlock that double or that match is every time you hit the thumbs up on the episodes in this series, I'll add an extra dollar to how much I'm donating. So right now, you guys, by hitting the thumbs up, can add $1 to our fundraiser for charity. We've already raised over $200,000 right here, which brings our total fundraising to just shy of $2 million, but this is just from the last couple of challenges that I've been doing. So every time I do these challenges, it's an opportunity to raise awareness and raise money for good causes. And so these are some of the charities I've been donating to during this last round, primarily, as you can see, children's hospitals and humane societies and things like that. Okay, so let's go ahead and jump right into the alpha phase. So alpha phase is when you are practicing in a simulator. Practicing in a simulator is critical before you ever put real money on the line. Now, it doesn't matter if you use our simulator that we've built here at Warrior Trading or you use a different simulator. This is our simulator right here. And this gives you the chance to pull up a stock, whatever it is, and you can see the market data, which I'm going to walk you through what all these numbers mean during today's session. You can see the charts. You can see the news headlines, and you can actually go ahead and you click the price, you can click the buy button, and boom, you're going to execute a trade, and you're in. And now you decide you want to get out, you click down here, you click sell, and you're back out. So this was a break-even trade. I was in, I was out, I was break-even. But every single time you take a trade in the simulator, we're aggregating your data. So you can go at the end of the day or the end of the week or the end of the month, whatever the case might be that you like to do, and you can review all of your metrics. And this is very important because you should never trade with real money until you've first proven you could be profitable in a simulator. All right, so phase 1 is trading in the simulator. That's the first step. By trading in the simulator, you're going to gain a ton of experience. And this is how you begin to build your educated intuition. There's a process of converting knowledge into skill. Just because you read a book about skydiving doesn't mean you should jump out of a plane. You've got to practice. Just because you've watched a workshop or a class like this on day trading doesn't mean you're ready to trade with real money. You've got to do some time, pay your dues, and do some time in the simulator practicing. So I encourage you guys to start right away. And during your time in a simulator, alpha phase is all about gaining lots of experience. It's about taking as many trades as possible. Most days, there are enough stocks experiencing some degree of volatility throughout the entire day to give you the opportunity to put time in studying the level 2, getting in, getting out, studying the tape, getting better at reading when there's hidden buyers, hidden sellers, looking at chart patterns, and getting into all of the technicals that make up the skills that you need to learn in order to be a successful trader. So we're going to begin this class with a reminder to always trade in the simulator before putting real money on the line. Part 2, risk management. You know trading is risky. You've heard it from me a million times. I'm going to say it again. How do we minimize our risk? It first requires understanding that for most traders, what most traders do is they come into the market and initially they first put money into the market and they lose it, because they do not have a strategy, they don't have a system, and they don't have a set of rules. So they're really just shooting from the hip. They throw that money into the market, and that creates, as you would imagine, a poor track record. So you begin with a poor track record. What does that lead to? That leads to poor self-confidence. That then leads to increased pressure, desperation, and reckless trading, because now you feel a sense of loss and you want to make back that money. And so again, even though the logical response to the loss would be to stop doing what you're doing, most people try to muscle through it. They say, I'm going to get to the other side of this. I just have to stick with it. And they end up taking more trades, increasing their risk in an attempt to recoup previous losses. And that just further accelerates the poor track record. And what that ends up doing is creating a downward spiral. I don't want you to go on a downward spiral. I want you to go on an upward spiral. So the first element of risk management is trading A quality stocks. Making sure you're trading the right stocks is the most important thing, because when you're trading the wrong stocks, that's when you get yourself into trouble. So what are the right stocks? We're going to talk about that in a moment with stock selection, but before we do, I'll just show you today ENVB, WLDS, those are two stocks that I made the most on today. And look at this. These two stocks right here are the top gainers in the entire US equities market today. Combined, 200 million shares of volume, up 129%, up 90%. Both of them have breaking news. So these were the right stocks to trade. The most important thing is you're trading the right stock. Getting into the exact entry point and the exact exit point, we'll get there. But first things first, you want to make sure you're managing your risk by trading the right stocks. Because when you trade the wrong stocks, what ends up happening is you subject yourself to unnecessary losses. You're taking risk, as we all do whenever we trade, but you never really stood to gain that much. When you trade an A-quality stock, you're trading the type of stock that has the potential to go up 30, 40, 50%, maybe even 100% within the next 10, 15 minutes. So if you're risking 5% to make 50%, we would consider that to be a good risk to reward ratio. That's the way I think about trading, and that's the way everyone should think about it, is risk and reward. So if you are risking $1 to make $1, how often do you have to be right to break even? 50% of the time, right? Now, if you risk $2 to make only $1, you would have to be right 66% of the time just to break even. On the other hand, if you risk $1 to make $2, you only need to be right 33% of the time in order to break even. Now, I would say that's setting the bar pretty low. You could be wrong nearly 70% of the time and you'd still be a break-even trader. Isn't that exactly what you want to do? You want to set the bar so low that it's easier for you to be successful. That's what the logic would tell us. So now if we pull my metrics back up here, let's just take a look at where I'm performing. I'm at about 68.5% accuracy, and this is on over 33,000 trades that span more than a decade. What's my average profit loss ratio? As of this 10 plus year period, my average winners are about $1,600 and my average losers are about $1,400, which gives me, a slightly better than 1-to-1 profit to loss ratio. Now, if we looked at just the last year, we just look at last year, for instance. Last year was a $6.5 million year with 71% accuracy, as you can see right here, and the average winners were 3,500, and the average losers were only 2,000, which was getting closer to a 2-to-1 profit to loss ratio. One of the things that I'll tell you is that when the market is stronger and we're in a bullish market, the winners become bigger and accuracy becomes bigger. But when you're in a cooler market, obviously, the losers become a little bit bigger, accuracy declines. And so it averages out over the span of 5, 10 years, so on and so forth. So what's really important to take away here is that if you think first about risk, how much am I risking on this trade? And then asking myself, can I double whatever I'm risking? That you're then, by doing that, positioning the trade in a structural way where you're setting yourself up statistically to succeed, as long as you're trading the right stock. This is very important. This is where you want to be. Now, even if you don't end up here, even if you don't average 2 times whatever you were risking, if that was at least a reasonable target, it justifies taking the trade. And that's what's important. And so a lot of beginner traders, when you begin trading, and I was no different, you don't even think about that. You're not thinking about profit to loss ratio. We don't think in those terms, which again is a reminder that our sort of default instinct of the way we think about trading is not aligned for what is required in order to have success. So getting into a positive feedback loop means you begin first with, and we'll just go back to this previous slide here real quick. So we begin first with high accuracy, focusing on trading A quality stocks. By trading high quality stocks, we'll invariably have a better average winner versus average loser ratio, also called the profit to loss ratio. And that's going to then breed higher levels of consistency. When you've got high accuracy, a better profit loss ratio, and consistency, that's going to create a strong track record, which creates self-confidence. Now that self-confidence is going to increase profitability because now you could justify taking larger positions on every trade you take. When you look at my metrics right now and you see that I'm obviously doing quite well over long periods of time, you'd probably say, Ross, why don't you increase your share size? Why don't you increase it by 10%, 20%, 50%? And the truth is, I do. That's exactly what I do. I continue to gradually increase share size. Now, you can't increase your share size 10 times overnight. You don't know how the market will respond, if your strategy will still be sustainable and profitable at those highly elevated levels. Will you be able to get in and out as quickly, so on and so forth. And so you just continue to sort of gently push at the edge of your comfort zone to increase your share size and therefore increase your profitability, which is why last year was my most profitable year to date. I'm increasing profitability as I get further and further into my career. But this can begin even as a brand new trader. You focus on trading the right stocks, building a strong track record, and you do all of this before you ever put real money on the line. Now, let's talk about number 3, stock selection. So stock selection, how do you choose the strongest stocks each day? This is very simple. I don't want to overcomplicate it for you, and I don't need to, because I simply look at the leading gainers in the market. This day, GLTO, MOVE, those 2 stocks were the leading gainers. So you better bet those were the stocks I was trading. Today, the leading gainers are, as you could see, what was it? ENVB right here, and WLDS. These were the leading gainers, therefore those are the stocks I'm trading. Now ARTL and JTAI, those are other stocks I traded. At the time, they were a leading gainer, they were looking good, and then at a certain point they rolled over, momentum changed. And so some stocks will sustain that first position place for a long time, the whole day perhaps. Others will be in first place, and then there's a shift in momentum as traders move away from that stock as perhaps another stock comes out with news and attention shifts, and that's very common. But there's a theme, a common denominator, if we look at all of my biggest winners. And the first is that I make the most money on stocks that have 5 times higher volume on the day that I'm trading it than their 50-day average. So why would a stock have 5 times more volume today than what it averages? Well, we can look back to this example right here. we've got ENVB. ENVB today, right now, is actually trading 1,931 times higher volume today than its average. Currently, right now, it has 121 million shares of volume, and yesterday it had only 1 million, and a week ago it had 10,000, 20,000 shares of volume. So this stock basically went from having no volume for all of this period of time right here. I mean, I could actually measure the volume. So during all of these days, it had a combined volume. This is over the course of 76 days. It had 3 million shares of volume over 76 days. And then today, so 76 divided by 3 million, whatever that is. And then today it has 120 million shares of volume. It's because it had breaking news. The breaking news catalyst is what brought in the volume. And so when we recognize that I do the best on stocks that have 5 times above average volume, we realize pretty quickly that stocks don't have that type of volume for no reason at all. They have it typically because there is breaking news. But from a technical perspective, if I'm looking for a stock to trade, I can pretty concretely rule out that if it doesn't have at least 5 times above average volume, it's not worth touching. And then second is I do better when the stocks also have high total volume today. High total volume means that there's millions of shares of volume, which means it's easier to get in and easier to get out. It's very liquid. So more volume means you can take bigger positions. Bigger positions means you can make more money. So it makes sense that I would do better on a stock that has millions of shares of volume versus a stock that has only hundreds of thousands of shares of volume. Then I do the best when I'm focusing on stocks that are gapping up. A gap is when a stock moves up during the overnight or after hour pre-market trading session before the official market open at 9:30. And so gapping up essentially is another confirmation that the stock had some sort of news that was occurring overnight. So why would a stock gap up on 5 times above average volume? It's because of breaking news. So I'm a volatility trader and I'm a discretionary trader. I trade myself. I don't use an algorithm to trade. I don't have robo trading or anything like that. I manually choose when to buy and when to sell. And I do it based on searching for volatility, which is the result of stocks with breaking news. I also do the best on stocks between $2 and $20. And within that range, stocks between 5 and 10 are actually my ultimate sweet spot, as you can see right here, representing a considerable chunk of the total profit. But between 2 and 20 is really where I do the best. Now, the reasoning here is that stocks between 2 and 20 offer larger percentage returns for account growth. And so if I'm trading in a $2,000 account, I could buy 1,000 shares of a stock at $2. If that stock goes from $2 to $2.50 or to $3, all of a sudden I could double my account potentially in one day, or at least grow it by 40 or 50%. You simply cannot do that trading stocks like Tesla, Nvidia, or any large cap company unless you're trading options. But of course, the risk with trading options is that as a derivative, they have the risk of expiring worthless based on the movement of the underlying asset. And a lot of beginner traders and even more seasoned traders really struggle with options trading because of all of the factors that are used to determine the premium, and that you can actually be directionally correct. The stock can go the direction you wanted, and you can lose money because of time decay or because of volatility decay. And so while some traders may get into options, what I've always found to be more consistent for small account growth is trading outright stock on lower priced securities. So between 2 and 20 is really the sweet spot. And no doubt for the next small account challenge, I'll be focusing in this area. Now, everything I've shared with you so far is helpful insight into the type of stocks I make the most money on. But there's another criteria which is very important, perhaps the most important, and that is the float. The float is the number of shares available to trade, and stocks with floats of under 10 million shares make bigger percentage returns than stocks with larger shares that are outstanding. Float is the number of shares available to trade. And so when a company has a float of 5 million shares, that means that's the total number of shares that have been released on the open market. So if the stock is up, let's say, for example, let's just use a large cap company. We'll pull up a chart for Bank of America here. So Bank of America right here has a float of 7.1 billion shares. That's how many shares they had to sell to investors on the open market to raise enough money to provide capital for the bank, including buying all of the real estate, opening all of the branches, all the equipment, plus having the money on their balance sheet. So if Bank of America went up, let's say 50% in one day, how many of these 7 billion shareholders would want to sell? How many of those 7 billion shares would be up for sale because the stock is up 50%? Let's just say a quarter of them. So you've got, a little less than 2 billion shares that are for sale. Well, has this stock ever traded on even 1 billion shares of volume? And the highest volume day that we have here just in the last 5 years is about 200 million shares. That's the highest volume day ever. So what that means is that if the stock somehow was up that much, there would be far more selling than there was buying because all of these people want to lock up their profit. And so it would, in fact, prevent the stock from ever going up even close to 50%. Because even as it started to get up to 5% and 8% and 10% and 15% and 20%, you would have new sellers that are coming out to take profit. Now, on the other hand, when we have a stock like ENVB has a total float of 1.8 million shares. So there were 1.8 million shares yesterday that were owning the stock and whatever. And today they're up 150%. So if all of them want to sell and cash out because the stock going up 150% overnight is phenomenal, would they be able to do it without crushing the price? And the answer is yes, because there are so many people that are interested in buying this. The total volume today, as we can see, is actually in excess of 100 million shares. Now, you might say, how could there only be 2 million shares, rounding up, available, but 100 million shares of buying and selling? And that's because of trading. You buy from someone who's selling, you then sell to someone who's buying, and it's just this frenzied trading back and forth. So people are just trading the same shares back and forth. One person's getting out, taking profit, and another person's buying their shares, looking for the next leg up. And then the price goes higher, and then they sell to someone who, thinks it's going to go even higher yet. And so it's just this constant cycling of shares. But you need that cycling of shares to allow people who may have been holding it from the day before to get out with profit. And so this introduces the concept of float rotation. The number of times that the float has rotated will help us understand whether or not all of those insiders could sell. And so in this case, we've got float rotation of 60. The float is rolled over 60 times in terms of the amount of volume, total volume, and the float. And so that means that right now the stock is still up 130%, and everyone and anyone who wanted to sell has already sold, and it's still holding up. And that's a really good thing. That couldn't happen with Bank of America because there just really could never be enough volume on it that everyone who wants to sell could sell. And so as a result, Bank of America is a low volatility stock, which makes it excellent for long-term investing. It makes it excellent for pension funds and mutual funds. It does not make it excellent for day trading. So for day trading, we seek volatility. We need that range. And that means by default, we're looking at stocks with lower floats. So look at all of the floats on this day right here. None of them are more than 20 million shares. These are the leading gainers in the entire market. So this is a common denominator of these leading gainers. So stocks need high relative volume. We have a criteria for volume right here, which is the stock, for me to trade, should already be up 30% on the day. It should have a breaking news headline. The price ideally should be between 5 and 10 for like the real sweet spot. With 5 times relative volume, it should be a hot sector. What is hot changes from time to time. So whether it's crypto, biotech, or AI, whatever's the current hot theme. And the time of day when we see the heightened demand is between 7 a.m. and 10 a.m. This is an overlap between U.S. trading and European trading, when both U.S. and European traders are able to participate in the New York market open. So even though this is quite early, it's Eastern Standard Time for West Coast traders, they do get up in order to capitalize on this early morning volatility. And it's later in the day in Europe, but they are still, of course, awake because it's only in the afternoon, or really at 1 o'clock in the afternoon. And so they're trading the same time. So we have an overlap of time zones, which increases the number of participants in the market. So when you have all of this demand corresponding with a very limited level of supply, that is when we see these really big moves. That's when things get exciting. And here's an example right here, MLGO, 432% on the day with 300 million shares of volume. Yes, absolutely, I would trade this every single day I see it. So to break down my 5 pillars of stock selection, it's the stock at a minimum should be up 10%, 5 times relative volume, breaking news, between 2 and 20, and less than 10 million shares. We can tighten up those filters a little bit by boosting up the percentage return, boosting up the relative volume, or dialing in the price to get into a really sweet spot. But if you make it too dialed in, then you might run out of opportunities. So, by the way, everything that I'm sharing with you right now, you could download, and it's in my PDF. So I have these PDFs I've put together as worksheets that accompany these classes and are also available for members at Warrior Trading. But those of you guys tuning in on YouTube, you're welcome to download these. They will be a resource that you can utilize in your own trading starting right now. And it prevents you from having to memorize or take notes on everything that I'm walking you through right here. So now let's go to number 4, understanding candlesticks. So what we've talked about so far is trading in a simulator, understanding risk management, and stock selection. Candlesticks are the universal language of the financial markets. We utilize candlestick charts to give us context around price action, to understand if the price is strong or if it's weak relative to where it's been. If you say, hey Ross, the stock's $5, I don't know if that's good or bad. I don't know where the stock has been. So candlesticks give us the context. So I'm going to give you a quick lesson on decoding candlestick shapes. Every candlestick is made with 4 pieces of information. Every candlestick represents a period of time. The period of time is based on the candlestick chart. And so if I pull up this chart right here, I actually have 4 charts of the same stock. This is a daily chart, which means every single one of these candlesticks represents a day of time. Now this is a stock that, as you can see, is sold off for a long time. But each one of these candlesticks represents 1 day of time. So that's 1 day of price action. So the 4 pieces of information is the open, the close, which is our current price, the high, and the low. Those are our 4 pieces of information. This candle is currently green because it opened low and is closing higher. Now, in this case, the candle is still forming. Yesterday's candle here opened at the top, closed at the bottom. That was the low, and the high of day was also the open price. So that was a very weak candle. Now this is a 10-second chart, which means these candles are closing every 10 seconds. They're forming that quickly. This is a high-speed time frame for people who are very actively trading the markets. A lot of brokers don't offer 10-second charts because they use too much bandwidth. We do offer them for our simulator and for our members at Warrior Trading, so you can utilize them, and I use them in my own trading. This is a 1-minute chart, meaning each candle represents 1 minute of time. And this is a 5-minute chart, meaning each candle represents 5 minutes of time. So we've got the open, we've got the close, we've got the high, and we've got the low. Those are our 4 pieces of information that every candlestick communicates. This is the open and the low and the close, and the low and the high. So red opens at the top and closes at the bottom, whereas green opens at the bottom and closes at the top. So we do need our candlesticks differentiated as being red or green. Historically, in the age of black and white, everything, a green candle was white, it was hollow, and a red candle was black and was solid, filled. So now you know the anatomy of an individual candlestick. Let's go over a few candlestick shapes. The long body candle is a candle that has a very long body, and a short body candle is a candle that has a very short body. So a long body candle, being very tall, is very bullish. It communicates very strong sentiment. Traders are very euphoric, they're very enthusiastic, there's a lot of greed, maybe there's fear of missing out. People are being very aggressive, buying up the stock. So if I see a stock and it's moving higher, and I see a candle, let's say that's a long body candle like that, I understand the communication there is that this is strong. So the next candle then adds context, and the previous one adds context. If the previous candle was smaller, like this, then what this is showing is that it's gaining momentum, right? If the next candle's bigger, the momentum is continuing, and the previous one's smaller than that. Or if the next candle starts to get smaller, then we're kind of running out of momentum. We're cooling off. So you can see based on the shape of the candle, whether momentum is building or it's waning. The areas that I pay the closest attention are when I think the trend is about to shift from moving higher to moving lower. So then it slows down right down here, and we might think, uh-oh, the trend is getting ready to shift again. And so we're looking for that first green candle and then a rally back up. Now that's a very big swing, but you get the idea that the areas that I focus are where the trend is about to change. The quicker you are at identifying changes in trend, the more money you'll make. You'll be buying before the trend changes or right as it changes from down to up, and you'll be selling just before it changes from up back to down. And what you'll find is that most stocks trade in sort of these waves where they move up and down and up and down. And so you get many opportunities throughout the day to time these entries and exits right around the pivots in price. So long body candles are very bullish, and smaller body candles or short body candles are a little bit more bearish, communicating a bit weaker sentiment. We then have doji candlesticks. A doji candlestick is defined by a candle that opens and closes at nearly the same price as these ones that are circled do. So opening and closing at the same price, which is giving us that flat line. Opening and closing at the same price right here, opening and closing at the same price right here. But in this case right here, this is called a gravestone doji. And it's called that because while the price opened and closed at the same spot, it pushed higher and then dropped back down. That's ominous. It's bad. What it means is that while the stock squeezed up, the sellers pulled the price back down and ended up closing flat. Whereas down here, the dragonfly doji, dragonflies lifting off, is bullish because although the price sold off at the bottom of this candle wick, it rallied back up and closed at the top. Now this one here opened and closed at the same price, but popped up and dropped back down, which communicates indecision. So if we are looking for a potential change in trend, these would be great indicators to be searching for, looking for these dojis, because they communicate indecision. If a stock is indecisive after having just made a big move up or a big move down, then that indecisiveness could be the beginning of a change in trend. A spinning top candle is similarly indecisive. There's a small body, but there's an upper candle wick and a lower candle wick. The hammer candle is present at the bottom of a sell-off. You have the lower candle wick right here, which is bullish because while the price sold off, the buyers came in and rallied it back up. And then this little small body takes the form visually of almost like a mallet. And so we say it's hammering out the base. So a hammer here is bullish. Now, in this case, an inverted hammer, after a big squeeze up, is considered bearish because you've got that big topping tail candle and then you've got the drop back down and you've got this small little body right here, shooting stars come back down to earth. So this is indicating a possible change in trend. Now the shooting star could be green or it could be red. If it's red, it indicates the reversal has already begun and then it's confirmed that it continues as those next candles drop further. This is a tweezer top, two topping tails back to back. This is bearish. These tweezer tops typically mean that this is the top, there's resistance, and the price cannot go higher, whereas a tweezer bottom represents support and the price is holding that level for a reversal back up. So what you're learning here are the building blocks. Individual candlesticks are letters of the alphabet and they combine to form words, and those words are buy or sell. That's how I interpret them. So the individual candlesticks combine to form multi-candlestick chart patterns. And those multi-candlestick chart patterns are what we teach and I go over in depth for members at Warrior Trading. Now, I want to share with you so you can walk away today with one multi-candlestick pattern that you can begin trading. I want to share with you one of my favorites. This simple pattern is something that I trade almost every single day, and it's so logical when you think about it. So first we have a stock squeezing up very quickly. So how do we find it? We'll find the stock squeezing up on the scanners. So in this case, UPXI hits my scanners right here, and these are the same scanners. This is a high of day momentum scanner. And so what it's doing is it's searching the entire market in real time for stocks that are moving higher. You set your audio alerts on it, and then you'll get a ding through your speakers on your computer, and you'll hear ding, 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 we've got something moving. So when I see something moving like this, I click the stock, I pull up the chart, and I look for the pattern. So what's the pattern? I let it squeeze up, and I wait for a pullback. I let it dip, and now what I'm looking for is a change in trend. So sometimes we'll have a doji here. Sometimes we'll have a hammer, a bottoming tail. Other times we just have a small little red candle, a short body candle, and then the next candle we're looking to go green. So right here, as that candle goes green, the change in trend has occurred. So what is the moment that the change occurred? The moment is when this green candle broke the high of this candle right here. That's the moment the change occurred. And so that's the moment that I buy. What's my max loss on this trade? My max loss becomes the low of the pullback. So now I'm risking 1x for max loss, and profit target has to be 2x, right, to justify the 2-to-1 profit loss ratio, and that would give me a target of back to the high a day. Now, retesting high a day is a logical target. Usually stocks will retest the high a day, and then they'll push a little bit higher before then giving another pullback, which presents yet another opportunity to take another trade. And that's the beginning of these waves that we see in the market. So I'm going to give you a little pop quiz here. All right, so we're going to look at the actual chart. Now you've seen the green candle squeezing up, the little pullback, and what we're looking for is that first candle to make a new high. So would you be a buyer right here if that next candle goes green? I hope the answer was yes. You can see right there. That was the apex, the moment that candle made a new high, and then we squeezed all the way back to a new high of day. And that's a simple base hit, jumping in, jumping out, and taking profit. Now, I do have specific exit indicators that I rely on, which tell me when to get out, so I don't sell too soon, and so I also don't hold too long. But the entry is arguably more important, so you're not chasing. You've got to make sure you've got a good entry, so we focus on entries first. What about this one? We've got all these green candles in a row. We wait for a pullback. Now we have that bottoming tail. Not quite a hammer, but almost. We're looking for first candle to make a new high right there, and then a retest a high a day. This one goes even higher. That's great. That's an entry at about $3.70 and a squeeze all the way up to over $4.70 right up here. That's phenomenal. It's $1 a share. That's a great risk to reward ratio. Now, what about this right here? Okay, so in this case, this is a little bit different. We already had a pop. We had a pullback right here, which was good. That was fine. But now we have a little bit higher selling. These are bigger red candles. Notice the volume profile. We're seeing more selling. The problem when you start to see high volume selling coming in is that these stocks often unwind. So the amount of volume on any given candle helps communicate whether these are going to go up or go down. One of the things that you guys have the benefit of is that for members, at least at Warrior Trading, you can listen to my real-time market commentary as I'm trading. You get to see my positions window. You get to see as I'm getting in and getting out of trades. And so you get to hear me share with you my interpretation of the price action and call out things like, hey, we've got higher volume selling right here. Now, I might be wrong. I'm not right on everything, but it seems to me that it makes a lot of sense to listen to someone with real money on the line who's been trading for a long time, especially as a beginner, versus trying to just figure this all out yourself. Because it's so easy to miss one of these little subtle indicators. So is this an entry right down here? The answer is no. There is no setup here. The stock had setups earlier in this area, but now it's just going sideways. There's no trades there. This one, what about this? Well, unfortunately, you might say it looks good, but this indicator right down here shows us that the blue line has gone below the orange. That's a negative MACD, which is a divergence. We don't like that. This is a no trade. And boom, that's a no trade. It doesn't work. What about this one? Higher volume selling. Once again, that's a problem. So we look at the volume profile. What about this one? Now, this is okay. High volume building. Yes, you've got a red candle here, but in total, the buying volume is much stronger. Our MACD is positive, and this is a good entry spot. Boom, that's a nice squeeze higher. And so once you start using your technical indicators, once you start recognizing these buy and sell signals, it's very quick to eliminate setups that just aren't going to work, and you don't trade them. What about this one? Now, this looks pretty good to me. That's a nice squeeze. Yes, you have a little higher volume on the top candle, but nice little pullback. We stayed positive on the MACD. A higher volume on these green candles, which is good. Volume comes back in. We break through the high. This is another one right here. Higher volume now. A little pullback. MACD is still open. We push a little bit higher. And then we kind of stall out up here. Then the MACD goes negative. Higher volume coming in. And this becomes a little bit choppier. You might not end up taking that trade right there because of this initial move. So I usually find that I do the very best at the beginning of a move. And I don't want to overstay my welcome. Now, in order to trade, I have to execute my orders using market data and level 2. So when you pull up your trading software, and this is one of the platforms that I use, but you could also see our simulator right up here. when you pull up this software, you actually see all of these numbers. This is market data, and this is communicating to us all of the buyers on the left and all of the sellers on the right. The bid is what people are bidding to buy. The ask is what people are asking to sell. And because these people are selling at 439, you could buy from them right now. You click 437, whatever, you click buy, and those shares are yours. If you want to get out, let's say at 437, 438, I put my sell order at 437, and now I've got to wait for the price to go up. I've got to wait for someone to come and buy my shares at 437. So I could wait and wait and wait. And I might be okay doing that, especially if I'm already up on the position. Or if I decide, you know what, I think I should just get out, what I could also do is I could sell at any time to one of these buyers right here. And so in this market, you can buy the moment you want to, and you can sell the moment you want to any one of the buyers or sellers that are right here sitting on the book. Now, some of the buyers and sellers on the book are market makers. They make the market through arbitrage. So they're always buying from someone who sells, and they're always selling to someone who wants to buy, and they profit from the spread. So essentially, some market maker, institution, bank with very deep pockets just sits there providing some degree of liquidity all day long. So now as it comes back up to 37, 38, there we go, there's 39. I put my order at 39, let the price go up, and my order got filled, and I'm out. Let's see, I got filled at 38, I guess it was. So I'm out with profit, and that's good. Now, this is an important concept. Whenever you're trading, you're buying from someone who's selling. Whenever you're selling from someone who's buying. And so we're actively participating in this market. So what if we pull up a stock, we look at this level 2 data, it's called level 2 data, and we saw that there was a 100,000 share buyer. That tells us that there's someone out there that wants to buy a lot of shares. That's very bullish. That's a positive thing. What if we see there's a 100,000 share seller? Well, that's a weakness. And so using the market data in combination with our charts and indicators, we now can form a very strong bias, or well, I don't want to say a bias, a thesis of what we think the stock is going to do. And so that gives me confidence in taking my trades. So I execute my orders using level 2 market data. And what's very important is that whenever I'm trading, I am using hotkeys. So I am empowering, I'm empowered through my keyboard to execute these orders very quickly. So if we go back to here, if I press Shift 1, it'll buy 1,000 shares. So Shift 1, I'm in, and then Control Z, I'm out. And just like that, I can buy, and I can sell, and I can buy, and I can sell, and I could do that all day long. Now, of course, if you just buy and sell like that, as you could see, you're not really making money. The price has to be going up. But what you want is software that allows you to get in and out that quickly. Now, I do have a list of brokers that I'm a big fan of that I think are phenomenal and have great software, and a list of brokers that I would never use. So I have other episodes here on YouTube where I rank the best brokers and the fastest brokers, which you guys could check out. But all that is to say, not all brokers are created equally. Is you want to make sure that when you're first practicing, of course, you're using a simulator. Some brokers don't offer simulators because they don't make money when you're trading a simulator. They just want you to use real money. So unfortunately, most simulators you might have to pay for a little bit just to cover the market data costs. But you want to make sure when you're trading that you've got software that allows you to get in and out quickly. The last thing that you want to have happen is have a stock pop up 40 or 50 cents a share, and you can't sell and take profit because you're fumbling with your keyboard to point and click and enter the correct price and the correct numbers, and then your fingers are too fat and you can't press the buttons right, and then finally now the price is down and you miss the whole move. It used to happen to me all the time until I learned that there's brokers out there that are better, and lo and behold, that's what a lot of the more successful traders are using. Better brokers. You use better tools. And so it's important to match the tools for the type of trading you're trying to do. Number 7, you've got to understand your metrics before you ever trade with real money. And what that means is reviewing your performance by day of the week, your performance by time of the day, your performance by the price. So we aggregate all of the data for you guys. So you can look, for those of you guys who are trading in our simulator at least, so you can see how you're performing. If you're not using our simulator, you can still upload your metrics to a third-party platform. I use TraderView. This is the platform that I've been using now for more than a decade. So all of my trades in TraderView, I've been thrilled with the platform. It's been really solid. I don't have any affiliate relationship with them, so it makes really no difference to me one way or the other what you might choose to use. But it's been really good. And what I like about it is the way you can kind of break down your performance. So you can go into a detailed report and you can look at your profitability based on time of day, based on, of course, the price and the volume. So you see, I make the most on this price range, right? That's good to know, based on, all of these details. And as I go through them, I recognize the stocks I make the most money on. Well, what do these stocks have in common? What's the sector? You start to develop a connection you start to see patterns. And picking up on patterns is critical to success in the market. You recognize a pattern of this is where I make the most money, you want to lean into that. You recognize a pattern of this is where I'm struggling, you want to pull away from that. And that's ultimately what trading is. It's using your metrics to make informed decisions. You're not making decisions based on gut, what you think, based just on what you know. Now, part 8 is the beta phase in the sim. Transitioning from a simulator to real money has to be done carefully. And so your first phase is alpha phase, where you're just trading as much as possible, getting in, getting out, getting in, getting out. And now we move forward to the beta phase, which is your dry run for going live. During the beta phase, I encourage traders to focus on just taking one trade a day, keeping it really simple, getting in, getting green, getting out. Success is about keeping it simple. You can make a living trading doing just one trade a day. There's people that trade hundreds of times a day and they don't make money. Just focus on finding one really good setup, getting in, getting out, maximizing your buying power on that opportunity, and capitalizing on it. So the one trade a day challenge for the beta phase is focusing on stocks that meet all 5 pillars of stock selection, looking for one of the entries, such as the first pullback, which I already shared with you, and getting in at that apex and then not selling until you see a valid exit indicator. During this first 10 days of taking one trade a day, by the end of it, you will know whether your accuracy, very, very simply, is greater than 60%. You want it to be greater than 60%, and you want to be profitable. If you are, you then replicate that same first 10 days with real money. Each day, you report on your trades using this trade reporting doc, and each week, you report on your progress. And as you watch your progress, you monitor where you're seeing improvement and where you're struggling, and you make adjustments as needed. So the decision to go live and to start trading real money is not taken lightly. You don't do it until you've first proven you can make money through the beta phase. So one trade a day, and I've asked members to send over some of their calendars so I could share them with you. And most traders are really good about this, taking 1, maybe 2 trades a day. Some take a few more, some take a few less. But I want to see you have a calendar like this before you go live with real money. The reason is I want you to have a track record that you can anchor yourself to that is your source of self-confidence, that you know it's worth putting real money on the line because of what you've done in the past. It's so important. So here's your next step. We have just scratched the surface and there is so much more to cover. So what I'm gonna do is I'm gonna put links to a couple other episodes right here that I think you guys will enjoy. They're a deeper dive, they continue further. There will be more episodes in this series leading up to my next small account challenge. If you wanna watch over my shoulder during this challenge or any of my upcoming challenges, there will also be a link for a 2-week trial at Warrior Trading, which is $20. $20 for 2 weeks, watching over my shoulder, going through a selection of classes from my full-length Warrior Pro curriculum. You're gonna get a lot out of it. Now, if you found value in this episode, I hope you hit the thumbs up. Remember, every thumbs up will add an extra $1 to the match for donating money to charity. And so I wanna thank you guys for participating in this challenge with me. It's really exciting. And stay tuned for the next episode coming real soon. And a final reminder, as always, that trading is risky and my results aren't typical. So manage your risk by always practicing a simulator before putting real money on the line. And make sure you check out these episodes right here and right here that I think you will enjoy for a deeper dive. We've got a lot more to learn, so let's keep studying.